It's time for today's strategy session as well. And our next guest has some interesting thoughts about where equities are going in 2025. Joining us now, we've got Eric Beyrich, Sound Income Strategies Co-Chief Investment Officer. Eric, great to have you here with us. As we just laid out how this year has really transpired, your expectations and top plays going into 2025.
Well, great. Thanks for having me. It's good to be here. Yeah, my perspective is a little different than some of the narrative that we've seen. And basically, I think the market is set for a rotation. We've been waiting for it for a while. It's been led by the mega cap technology names or even some of the drug stocks and the GLP-1 data. But as their growth rates slow and their valuation multiples look more stark, we expect them to continue to retreat in a sawtooth fashion, and some of the value names that have really underperformed over the last 2 years to start to rise because their relative growth rates look comparable and their valuation multiples in many cases are a third of that of the market. So that's basically what we're looking forward to. But if you look at the growth rates in the S&P over even the current year, it's actually been negative growth if you take out the Mag 7 names. And even prospectively, with the Mag 7 names slowing, the growth rate going forward, which some have in the double digits, is really hinged upon everything else coming back. So that's a little bit of a difference. And another difference is you guys were really negative on the Fed earlier in your program, and you had some guests talking about it and people talking about the Fed possibly raising rates. I don't think that's the case. Certainly, if you listen to Greenspan's testimony if you listen to Powell's testimony last week.
Well, if Greenspan was still the Fed chief, Eric, I'd be bullish on the Fed. I mean, that guy just cut rates forever and sowed the seeds of a housing bust.
Dated myself. When Powell spoke last week, he was very clear. He wanted to be very balanced. He didn't, when he was asked specifically if they were going to raise rates, he said he doubted it. And I doubt it as well. If you look at the growth rates across the industries, I'll tell you about those in a second if you want. It's been slowing down pretty much across the board, positive earnings revisions. And if it wasn't for housing being stubborn, inflation would be substantially lower. And it's a 40% factor in the inflation measured in CPI, and it's such a big weight. And one of the reasons why it's up is because the biggest factor in housing is typically interest rates, and the Fed has been creating inflation in money and inflation and interest rates. So as rates come down, you're going to see housing inflation come down as well.
Eric, Eric, let me just hop in here real quick. I like in your notes that you called out or tried to define what the average stock is in a market that's still pretty bulled up. And I hear what you're saying on Pfizer. I mean, the valuation multiples, P multiple of under 9 times forward earnings for a Pfizer. I mean, that sticks out. Do you think next year will be the year of the value investor?
I think the value investor will come back next year. There's two arguments for value stocks. One is the mathematical duration argument. And the mathematical duration argument basically says that value stocks do better when interest rates are higher typically. And that's a bond manager's argument. And that's actually going against value. But what's going to help value more is just the abject extremes that we've had. So you have the market itself on sort of a PE basis. It's defined by the S&P 500, now trading at almost 25 times forward earnings. The average stock on a forward basis is trading at more like 18 times forward earnings. And that includes the mag names. If you take those out, it's more like 16 times earnings, which is normal for the market. So there's a big divergence in what people are paying for these high growth names. And they're paying for them because they're scarce. Well, as the rest of the market starts to grow more and their growth rates slow, it's just going to be a shifting away from the more expensive names, which are still great companies and they have excellent free cash flow. And I'm not knocking them fundamentally. I'm just saying the price has gotten too high. And other things that have had more challenged fundamentals are going to start to look a little more stable and do better. So in the case of Pfizer, we talk about that. I've got a whole bunch of stocks that are under 10 times earnings. Pfizer is one of them, but the earnings growth rate of Pfizer is lower.
Yeah.
It's in the low single digits now, and that's before you take into consideration the RFK pressures on healthcare and the anxiety, which has created a depression, which is usually an opportunity. Usually, we've talked about this on your show before. valuations are a pendulum. They go too far in both directions.
Right.
And when people get scared, the sentiment gets overly negative. So it creates an opportunity for a sentiment reversal.
So Eric, with all of this in mind, is there one value investor's North Star that you would be pointing to right now?
The value investor's North Star, you mean besides Warren Buffett? No, and he's been pooling cash, which is a negative thing. No, I don't know that there's a North Star. What we look for are companies that are cheap with temporary problems that can be resolved. Things are always expensive for reasons. We like to buy things that are cheap for reasons that we think are temporary or not good reasons at all, like, technical oversells and things like that. There are good reasons to be negative on most of the value stocks that we buy, but we think there are better reasons if you have a slightly longer horizon to be more positive. So, I gave you guys some stocks for that your audience hasn't yet heard yet that are all trading below 10 times earnings, and they all have catalysts for improvement. So in the case of Pfizer, besides the activism involved, they're cutting costs and they have a very good pipeline, which isn't being factored yet because as things make it through phase 2 and phase 3 and get into the market, it takes time and there are launch costs and things like that. So we think there's a reasonable scope in the case of Pfizer or in Glaxo, which we can talk about as well, where their earnings are going to accelerate beyond what's the consensus. And because they're so cheap and because they're paying such fat yields, you get a 6.7% dividend from Pfizer, which looks very secure. Similarly, with Glaxo, you're getting a much improved growth profile. You're getting almost double-digit earnings growth and a sub-10 multiple and a 4+% dividend yield. Those look like extreme values to us in sort of the large cap stocks.
All right. Eric, we got to leave things there on the day, but certainly do appreciate it and want to continue to have this conversation, especially checking in on the performance of some of these picks that you're mentioning as well. Eric Beyrich, thanks so much for taking the time.
Thank you, guys.